In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about why FIIs or foreign institutional investors are exiting India at a record speed that has never been seen before. In the second story, I'll talk about how India's rural sector is shaping up our economy going forward. And in the third and final story of the day, I'll talk about TVS Motors results and what it really means for the overall motor economy of India as well as the EV sector. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news in the financial markets in a way that is one level deeper and nuanced as compared to traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 25th of October. Let's begin with our first story of the day. In October 2024, the Indian stock market witnessed one of the largest sell-offs by foreign institutional investors or FIIs in its recent history. FIIs offloaded a staggering 82,000 crore rupees, which is around 10 billion US dollars, in just one single month. This outflow of foreign money has surpassed the previous record of around 58,000 odd crores, which FII had withdrawn during the COVID-19 pandemic during March 2020. So in this story today, let us understand why exactly this has happened and what it means for you and me as investors and for people who track the markets. But before we get into the details, for the sake of those people who do not know, let's first get a very clear idea of who exactly FIIs are. Look, simply put, FIIs or foreign institutional investors are large financial institutions who come from other countries. These could be hedge funds, pension funds, or even asset management companies which invest huge sums of money in countries like India. They move their money across international markets where they look for best returns. When FIIs buy stocks in a country, they can potentially move the markets. The reason why FIIs are so significant here is because when they buy stocks in a particular country, they can potentially move the markets very significantly. There's definitely also a sentiment angle to this, which is when FIIs buy or sell in large amounts, other investors start to see that as a signal which feeds into their own decisions. And the best guess is that in October 2024, which is this month, this is exactly what has played out. Now, the reason why this sell-off is a topic of discussion today in the first place is because it comes as a bit of a surprise. Earlier this year, FIIs had been buying Indian stocks which were helping the markets rally, but they are pretty much doing the exact opposite right now. Of course, no one can truly say why FIIs are selling or why the markets are falling right now, but we can also make a reasonable guess. Most of the analysts broadly attribute this FII sell-off to four primary reasons. First is valuation concerns. Look, the Indian stock markets have lately become very expensive as compared to other markets across the world. For instance, the Nifty 50 has a price to earning or PE ratio of 23x. This in simple words means that investors are paying 23 times the earnings of companies, which compared to PE ratios from the recent past is a little on the higher side. To give you a contrast, markets like China are currently offering stocks at a much cheaper valuation, and this may be making India a little less attractive to foreign investors who are looking for better returns elsewhere. And this brings us to the second reason, which is a shift to China. Now see, China has introduced massive stimulus measures in order to boost its economy, and this has made it very attractive as an alternate for global investors. And this has also led to a movement called Sell India and Buy China. The third reason is global economic factors. Look, weirdly, despite the recent 0.5% rate cut by the Federal Reserve of the US and the expectation of further rate cuts, the yield on 10-year US Treasury bonds has increased from about 3.6% to 4.2%. Now, one reason for this is that traders got too excited about further aggressive cuts by the Fed and now are readjusting their views. Another possible reason of this could be maybe the yields are saying that this will be a shallow rate cut cycle and that we are unlikely to go back to the pre-pandemic world of zero interest rates. Bonds and equities compete for investment dollars. As bond yields rise, the opportunity cost of investing in equities increases because investors can achieve higher returns with lower risk by investing in these bonds. This shift can lead to capital moving from equities to bonds. So that could be a factor in why FIIs are pulling their money out of Indian markets and are reallocating it to the US and some other countries. Another factor here is the strong dollar. The US dollar, after falling for the last few months, has now been following the same direction as US bond yields. The fourth reason which analysts attribute to is disappointing corporate earnings. Look, some key sectors in India like consumer finance and energy have posted weaker than expected earnings this time around. This may have dampened investor confidence a little bit and has added to reasons why FIIs are withdrawing their funds. Many brokerages have been reducing their earnings growth estimates for Nifty. They are expecting Nifty earnings to grow between 4 to 7%, which is a multi-year low at this point in time. Now, this wave of selling has caused a noticeable impact on the Indian stock market. The BSE 500 index, which tracks the performance of the 500 top companies in India, has fallen by about 7% from its peak. Sectors like consumer finance, FMCG, which is short for fast moving consumer goods, and energy have been hit the hardest, as these were the areas where FII had very significant investments. But all that said and done, even though foreign investors are selling so heavily, the Indian market has not quite collapsed if you think about it. And if you're wondering why, it is because domestic institutional investors, or DIIs, which for your context includes mutual funds, insurance companies, and pension funds, have stepped in to buy shares. In fact, DIIs bought 83,200 crores rupees worth of shares in October 2024, and they more than made up for what FIIs sold in this period of time. So strong domestic buying has definitely helped stabilize the market and also prevent a full-blown crash, so to speak. Retail investors also have helped here. They are the ones who largely invest in the market through SIPs, and SIPs have steadily been increasing and are averaging around 22,321 crore rupees per month. And this signals that domestic investors still have some confidence in the Indian market's long-term potential, even though FIIs are pulling out. The fact that domestic investors are buying during this period of foreign selling shows strong confidence in India's future. Government initiatives like the PLI or the Production Linked Incentive Scheme are expected to boost the economy even further, which could hopefully make India an attractive destination for investments in the long run. Even if we take a cue from history over here, the Indian stock market has usually bounced back from large FII sell-offs in the past. To give you a quick example, after the global financial crisis in 2008, the market fell very sharply but then recovered by over 127% in less than 12 months. Very similarly, during the COVID-19 crash in 2020, the market rallied quite sharply. So while in the short term the Indian market is likely to remain a little volatile, things should hopefully cool off for the better in the long term. With that, let's move on to the next story and talk about how rural India is contributing to the growth of the Indian economy. See, the Indian economy is very heavily driven by consumption, which means how people spend on things both in rural as well as urban areas. In fact, 60% of the Indian economy, or our GDP, comes from people spending on goods and services. So it is very crucial over here to understand where and how exactly the spending is happening in order to get a clearer picture of where our economy might be headed. Let's start by looking at how people are spending in India. See, this is a bit of a mixed story here. In rural India, things are starting to look a little better than they were ever before. People are spending more money, especially as the agriculture season is doing well. But in urban areas, the recovery is not as strong as we'd like to see. This brings us to a tale of, so to speak, two Indias, with the countryside showing promise while the cities are still a little more cautious. I'll break this down step by step, starting with the good news from rural India. See, rural India is seeing some signs of recovery like I mentioned, and data also backs this up. Good monsoons as well as kharif sowing agriculture plays a huge role in rural prosperity, and it all starts with the rain. This year rainfall has been particularly helpful for farming. A key indicator here is the production weighted rainfall index, or PRN, which basically tells us how effective the rains have been for agriculture. The PRN this time around stood at 107% of the long-term period average. This means the rainfall has been better than what is typically expected every time. This is of course good news because good rainfall ensures that crops also grow well. To give you an example, this year's kharif season, which is one of the main cropping seasons in India, saw 1108.6 hectares of land sown. That is a 1.9% increase as compared to last year. I know this might sound like a small number to some of you, but in a country where millions of people depend on farming, it is a very significant rise. On top of that as well, water reservoir levels are at 87% of capacity, which is way above the 10-year average. This means that farmers will have enough water in the next season, which is called the Rabi season, to ensure that crops can continue to grow smoothly. Now, another positive sign here comes from the falling demand for jobs under the Mahatma Gandhi National Rural Employment Guarantee Act, or the MNREGA. Now, some of you might be thinking that falling job demand is bad, but in this case specifically, it is actually good for us. Fewer people are looking for government-backed work because they are finding employment elsewhere, particularly in agriculture, where there has been a lot of work this season. The demand for MNREGA jobs fell by 16.6% in the last quarter, which indicates that rural people are finding other sources of income. Now, one way to measure rural prosperity is by looking at what exactly people are buying. Two-wheeler sales, which is mostly bikes, are up 10.7%. Now, for rural areas, these vehicles are very essential for getting around. So when bike sales go up, it usually shows that people are willing to spend on transportation, which in a way of speaking is a sign of improving financial conditions. Fertilizer sales have also seen a rise in rural India, and this is important because it shows that farmers are investing in their crops. Fertilizers, like it's pretty much obvious right now, is very crucial for farming, and more sales here usually means that farmers are preparing for a good season ahead. Now, another big indicator of rural spending is how fast moving consumer goods or FMCG goods are selling. Companies that sell these products are seeing better sales in rural areas than in cities as well. To give you an instance, Suresh Narayanan, who is the CMD of Nestle India, pointed out that demand in rural India has remained stable even though demand in big cities is slowing down. This is another very strong sign that rural India consumption is holding very steady. Now moving on, let's talk about the urban side of things. Like you would have already figured, unlike rural India where the recovery looks a little more promising, urban India is moving at a relatively slower pace. Air travel is recovering but not fully yet. And this is important because air travel is a great indicator of urban spending. More people flying means more people are willing to spend on things like vacations as well as business trips. While domestic air passenger grew by 7.6% in July and 6.7% in August, it is still not back to pre-pandemic levels. This means people are flying more than before but not as much as they used to do before, and this suggests some caution in their spending. Now let's talk about e-way bills, which are documents generated every time goods are moved across the country. In September, the number of these particular bills increased by 18.5%, and they showed that trade is happening. Goods are moving around the country, but it is not quite clear if this is leading to a strong rise in consumption. Trade is up, but the actual spending is not quite there yet. Then there is also cement and steel, which are very key indicators of construction and infrastructure activity in the country, which of course are a big part of our growth. Steel consumption grew by about 10% in August 2024, which suggests that infrastructure projects are moving along. But cement consumption tells a bit of a different story here. It dropped by about 3% in August as compared to last year. Even though the numbers for the year as a whole are slightly up around 0.7%, it is clear that momentum is lacking here. This suggests that private construction, especially in cities, are still facing challenges. Then there's also the factor of buying big ticket items like fridges, washing machines, TVs, etc., which in short could be called as consumer durables. Now the sales of consumer durables have grown by 8.2%, which is okay maybe, but it is not the kind of growth we'd expect in a strong recovery scenario. People seem to be waiting a little more for economic stability before making these big purchases. Another important signal of cautious spending is the fall in passenger vehicle sales. For 2 months in a row, sales of cars have dropped in India. This is another sign that urban households are cutting back on big purchases, possibly waiting for more certainty before spending more money on their cars. So that said, rural India seems to be recovering faster than urban India. Thanks to good rains, strong sowing numbers, and improving farm incomes, the rural economy is gaining some momentum now. People in rural India are spending more on things like bikes, fertilizers, and everyday products. But when it comes to urban India, the recovery is slower. Air travel and trade, like I mentioned, is picking up, but not at quite the speed that we'd hoped for. Construction is a little sluggish, and people aren't quite rushing to buy big ticket items like cars or appliances. So it therefore seems that urban consumers are still playing it a little safe and are waiting for a little more stable times. So the key takeaway for all of us here is that if rural India does keep up its momentum that it currently has, it could give the entire economy of India a much needed boost. But for a full recovery, we also would need to see urban India start spending a little more freely. Until both rural and urban consumption picks up, the economy's recovery will likely remain uneven. With that, let's move on to the third and the final story of the day, where we talk about TVS Motors' latest quarterly results. Look, TVS Motors is one of the top Indian players in the two-wheeler market, and they recently released their financial results for the second quarter of FY 2025. For those of you who are unfamiliar, TVS is the third largest motorcycle maker in India in terms of revenue, and they are the second largest two-wheeler exporter in the country. And the reason this is important is because their results give us a great insight into the overall demand for two-wheelers both in India as well as internationally. To give you a sense of what is happening exactly with TVS, the company is now starting to move beyond traditional motorcycles and scooters, and they are expanding into electric vehicles or EV spaces. At the same time, they are also increasing their presence in rural areas where two-wheelers, like I mentioned in the previous story, are a primary mode of transportation. But that said, like any other large company, TVS is also dealing with some challenges, particularly in international markets where economic issues are impacting sales quite heavily. So to begin with, let's dive a little deeper into TVS's financials. TVS reported revenue of 9,228 crore rupees for the latest quarter, and they reflected a 13.3% growth as compared to the same quarter last year and a 10.2% increase as compared to the first quarter of FY 2025. EBITDA margin, which basically is a measure of profitability, improved to 11.7% from 11% last year and 11.5% in the last quarter. Profit after taxes or PAT also saw a 23% rise year on year with a 14.9% increase over the previous quarter. Now, a big driver of all of this growth for TVS is their EV business. Currently, electric vehicles make up around 6% of TVS's total two-wheeler sales, and the segment is looking great for further growth. A very interesting observation here is that despite all of TVS's electric vehicles being eligible for government incentives under the PLI or the Production Linked Incentive Scheme, TVS is somehow yet to include these benefits in its financial reports. So this could mean future gains as the company continues to outperform the industry thanks to a strong product lineup and consumer support. In India's electric two-wheeler market, TVS holds around a 20% market share and they rank just behind Ola Electric. To strengthen their position here, TVS is planning to launch new electric models in the second half of this financial year and also enter the electric three-wheeler market for both domestic as well as international export markets. Recently, TVS has also started exporting EVs to the Asian region, which marks its first step towards becoming a global player in the EV market. TVS CEO K. Radhakrishnan is very optimistic about India becoming a major export hub for EVs, and TVS is likely to play a key role here. Government support is also expected to push TVS's EV push, especially with the launch of PM E-Drive scheme, which offers subsidies and tax benefits for electric vehicle buyers. Although this scheme had begun after this particular quarter, the TVS management is hopeful that this scheme will drive their future demand. On the rural front, TVS has benefited a lot from the 9% year-on-year increase in rural demand for two-wheelers, which outpaced the 7% growth in urban areas. A good monsoon season has also boosted agricultural output, like I mentioned in the previous story, and also incomes, which has led to higher disposable income amongst the Indian population. The company's strong dealership network in rural regions allows it to reach these customers very effectively. But while TVS is expanding its export business, it faces some challenges in Africa, which is its largest export market, where currency depreciation and inflation are affecting sales quite a bit. But that said, growth in Latin America and Asia has helped offset slower sales in Africa quite a bit, and TVS is expecting some improvements in the African markets in the coming few months. Another very important part of TVS's business, which is a little less spoken about, is its financial services arm, which is called TVS Credit Services. This division helps provide financing solutions, particularly in semi-urban and rural areas, which makes two-wheeler purchases a little more accessible. TVS Credit's total book size grew by 13% year-on-year this time to 26,600 crore rupees, while the profit before tax increased by 20% to 220 crore rupees. Looking ahead, TVS has set aside 1,200 to 1,400 crore rupees for capital expenditure and investments in FY 2025, and they have a significant focus on research and development in the EV space. Their CEO Radhakrishnan also highlighted the importance of investing in new battery technologies and enhancing the EV lineup in order to compete with new players like Ola Electric and Ather Energy. So all of that said and done, the big question for all of us to ask here is, can TVS beat Ola Electric and Ather and emerge as the leader in EV space in the long term? It is hard to say for sure, but with a diverse product portfolio, growing rural demand, international expansion, and solid financial backing, TVS is positioning itself as a very strong competitor in both the electric and traditional two-wheeler markets. Now let's move on to the final section of the day, which is a small news tidbits. First, NVIDIA and Reliance have partnered to build AI infrastructure in India, as announced by NVIDIA CEO at the NVIDIA AI Summit 2024. This collaboration aligns with India's push for localized AI development and avoids the need to export data for intelligence. The partnership also highlights India's strong digital connectivity infrastructure and sets the stage for significant AI advancements. Second, Dalmia Cement is investing 3,000 crore rupees in Madhya Pradesh to build India's first fully renewable energy-powered 4 million ton cement plant. This marks a significant move towards greener industrial practices. Third, Twitter India's FY 2024 net profit plunged 90% due to a collapse in advertising revenue that followed Elon Musk's takeover and the dismissal of their global ad sales team. Well, that's all the news and stories I have for you today. I hope you found value in this episode. We'd love to know your feedback in the comments below about things we're doing right and the things we're doing wrong, so please do type in your thoughts below. This is your host Anurag Bansal signing off. Take care and I'll see you on Monday. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.